The foundational text on banking in India traces back to 4th century BC. The ancient Indian treatise, Arthashastra, written by Chanakya, directly mentions concepts of bankruptcy, commodity lending, and priority of claims. Centuries later, the oldest known commercial bank in India, the Madras Bank, was established in 1683 in British India. However, the foundation of institutional banking regulation was laid with the passing of the Banking Companies Act by Indian Parliament in March 1949, later renamed as Banking Regulation Act, which vested RBI with powers over licensing, management, amalgamation, liquidation of commercial banks. Along the way, the journey of commercial banking regulation has seen addition of more milestones in traffic. Cooperative banks joined as regulated entities in the 1960s. In 1997, RBI was further tasked with regulating all types of NBFCs. The RBI also fostered institutional development for the aspiring Indian economy in post-independence period. It created specialized institutions for industrial financing, rural agricultural financing, MSME financing, and nurtured them before cutting the umbilical cord. These institutions today are the drivers of Indian economy in their respective sectors. Incidentally, India is also the second oldest country to have introduced deposit insurance for bank depositors in 1961, also managed by RBI. The economic reforms of 1990s reshaped banking regulation in a very significant way. The recommendations of Narsimham Committee on Banking Sector completely reshaped the regulatory framework. Since then, over the years, the revised licensing and registration regimes have seen evolution of a variety of banks, catering to specific segments with optimized reach. The continually evolving regulatory approaches of RBI have now moved from being rule-based to principle-based regulation as the industry players have matured. All along, proportionality has been the cornerstone principle for regulating financial entities of various sizes and types. The recent tier-based regulations for urban cooperative banks and the scale-based regulations for NBFCs were the formalization of this approach. In early 2020s, RBI's regulatory process underwent another transformation with a shift from having entity-specific separate departments to having a unified department of regulation, regulating entities based on their activities, that is, an approach of same activity, same risk, same regulation. Further, within this unified department, RBI also emulated the twin peak model of regulation. Needless to state, customer centricity has also been the guidepost of regulation. During the previous 5 years, several measures were taken to bring the customer's interest to the focus in the delivery of financial services, while other measures were also taken to strengthen the regulated entities. To ensure that the banking and financial service sector is alive to the risk of money laundering and other financial crimes, the regulatory frameworks under the PMLA and conformance to the FATF standards is also a top priority of regulation. This approach was rewarded when India got a very enviable rating last year, a distinction shared by only 4 other G20 countries. Today, wide-scale consultative process and the net cost and benefits are carefully assessed for each piece of regulation. Recently, alternative regulation mechanisms such as self-regulatory organizations have also been institutionalized apart from structured interaction with regulated entities. RBI has adopted global standards in prudential and capital regulations without missing their domestic idiosyncrasies. In recent times, regulatory authorities have faced challenges of the climate risk and technology risk. These risks can be highly disruptive and can undermine the stability of financial institutions. Setting up a sustainable finance group under regulatory structure with multidisciplinary participation has yielded good initial results. A new tech model risk group has also been established in 2024. In the digitization of financial service, India was one of the first countries to frame the enabling regulation on the original digital lending, that is P2P, in 2017. The foundation of open banking were laid through Account Aggregators Framework in 2016. The platformization of credits led RBI to issue digital lending guidelines in 2022. To overcome the pacing problem, the new tech initiatives try to access the regulatory requirements in using AI ML by the regulated entities. As we complete 75 years of banking regulation, RBI remains ever vigilant to safeguard depositors' interest and maintain financial stability. Health of banking sector today is testimony to the effectiveness of regulation.